Imagine walking into a bank to open a savings account. You hand the teller $1,000. The teller smiles, takes your money, and immediately shreds. Huh, only $500 of those dollars right in front of your face. Right in front of your face. Then they look you in the eye and say, "Congratulations, this is the smartest financial decision you will ever make."
If that happened, you would call the police.
I'm telling you, it's right there. See? On the dial. We need to act now. Are you listening? Something's wrong. But when we wrap that exact same transaction in a leather folder and call it whole life insurance, we call it financial planning. Today, we are going to look at one of the most contentious, expensive, and misunderstood products in the financial world. We are going to break down the math behind permanent life insurance versus buying term and investing the difference.
We will see why your neighbor swears by it, why your financial advisor might be pushing it, and why the math suggests it might be a six-figure mistake for your future.
Before we get into the ugly numbers, we have to define exactly what we are arguing about. In the red corner, we have term life insurance. This is the simple one. It is pure protection. You pay a premium for a specific period, usually 10, 20, or 30 years. If a critical event occurs during that period, your family receives a substantial financial net increase. It is effectively renting insurance. In the blue corner, we have whole life or permanent insurance. This is a bundle. You are buying a death benefit that lasts until the day you die, effectively forever, combined with a savings account called cash value. Cash value. The sales pitch is that you are not just renting coverage, you are building an asset. It sounds responsible. It sounds sophisticated. But the devil is in the details, and specifically, in the price tag. If you are enjoying this deep dive into the financial weeds, do me a favor and hit the like button. It is the best return on investment you will get today, considering it is free. Now, let's look at the premium gap. This is where the argument usually starts. If you are a healthy 30-year-old, only looking for $500,000 of coverage, a term policy might cost you around $25 a month. That is the price of a couple of streaming subscriptions. A whole life policy for that same $500,000 payout? That is going to run you closer to $400 or $500 a month. It is going into your savings, but as we are about to see, that savings bucket has a massive hole in the bottom. Narrator, only the explicitly defined audio track is allowed. To understand why whole life is so expensive, you have to understand the problem the insurance company is trying to solve. With term insurance, the company is betting you will live, and you are hedging against the risk that you won't. Statistically, most term policies expire without paying out a dime. That is why they are cheap. The insurance company collects premiums from thousands of people and only pays out a few claims. But with whole life, the payout is guaranteed. Unless you cancel the policy, the insurance company knows for a fact that they have to collect way more money from you up front to fund it. They are not just insuring you. They are creating an endowment for your future death. This requires a massive accumulation of capital. And guess who has to supply that capital? You do, through those massive monthly premiums. Here is the part that usually gets left out of the brochure. You might think that if you pay $5,000 a year into a policy, only Alex speaks and lip syncs, all other characters keep their mouths closed, says you have $5,000 of value, you would be wrong. In the first year of a whole life policy, a massive percentage of your premium does not go into your cash value. Pocket. It goes into the agent's pocket. What? It can range from 50 papers premium. I mean, chart financial. This is why your cash value in the first couple of years is often zero or close to it. You are in the hole immediately. It takes anywhere from 10 to 15 years just to break even, meaning it takes over a decade for your cash value to equal the total amount of premiums you have paid. If you tried to sell an investment product that guaranteed a negative return for a decade, you would be laughed out of the room. Yet this is sold every day at kitchen tables across America. So why do people buy it? If the math is so bad in the early years, why is this a multi-billion-dollar industry? It comes down to two things: fear and forced discipline. Fear and forced discipline. The pitch is incredibly seductive. They tell you that the stock market is a casino. They show you charts of market crashes.
And ask if you want to gamble with your family's security.
Then, they pivot to the whole life policy. They show you a chart that only goes up. It never crashes, it grows tax-deferred, it feels safe. They also tell you that you are bad at saving. They say, sure, you could buy term but will you ask the invest the The alternative to this expensive bundle is unbundling. This is the famous philosophy of buy term and invest the difference. The logic is simple. You buy the cheap term insurance to cover your catastrophic risk during the years you actually need it, when you have a mortgage, young kids, and limited assets. Then, you take that massive difference in premiums, that extra $400 or $500 a month, and you put it into a low-cost portfolio. The goal here is self-insurance. By the time your 20 or 30-year term policy expires, you don't need the death benefit anymore. Foundation. But does the math actually hold up? Or is that just a nice theory? Theory? Let's stop looking at theory and look at hard numbers. If you think the safety of whole life makes up for the cost, I want you to see exactly how much that safety cost you over 30 years. Let's take our hypothetical 30-year-old. He buys a whole life policy for $5,000 a year. The illustration says that in 30 years, great, $250,000. Safe. Guaranteed. But now, let's look at the alternative.
He buys a term policy for $500 a year. He takes the remaining $4,500, the difference, and invests it.
Set again. Only Alex speaks and lip syncs. All other characters keep their mouths closed. That says if he puts that money into a boring S&P 500, even when you run that compound interest calculation, the result is staggering. That $4,500 a year,
Wealth! That is a $200,000 gap. That isn't just a rounding error, that is an entire retirement home.
that is college tuition for 2 kids. The safety of the whole life policy effectively cost you $200,000 in opportunity cost. And here is the kicker. That investment account is fully liquid. You can sell it, spend it, move it, or spend it whenever you want. There is another factor that insurance illustrations love to ignore, and that is inflation. Whole life policies often boast returns of 3, 4, maybe 5% eventually. But if inflation is running at 3%, equities, real estate, and diversified portfolios have historically outpaced inflation significantly over long timelines. By locking your money into a contract that yields bond-like returns, you are exposing yourself to purchasing power risk. $250,000 sounds like a lot of money today, but in 30 years, it might only buy you a used Honda Civic. By choosing the safe route, you are actually taking a massive risk. The risk that your money won't grow fast enough to keep up with the cost of living. Now, the insurance agent will jump in here and say, "But Alex, you're forgetting the dividends. Our company pays dividends." This is one of the most confusing parts of the sales pitch. In the world of stocks, a dividend is a share of profits distributed to owners. In the world of whole life insurance, a dividend is legally defined as a return of excess premium. Read that again. It is a refund of an overcharge. The IRS literally classifies it that way, which is why it isn't taxed. The company overcharged you just in case things went wrong. They didn't go wrong, so they gave you some of your own money back and called it a dividend. While these dividends do help the policy grow, they are not magical profit distributions. Business. If you spend any time on popular online video platforms, you have seen the videos. A guy in a fitted suit tells you that the wealthy don't use banks. He says they use a secret tax loophole to become their own bank. He is talking about infinite banking, or bank on yourself. This is a strategy that uses overfunded whole life insurance policies to create a pool of cash that you can borrow against.
The pitch is that you borrow from yourself, pay yourself back with interest, and capture all the money that would have gone to a traditional bank.
Yourself? The problem is, once again, the math. When you borrow against your policy, you are not actually borrowing your own money. Your money stays in the policy as collateral. Collateral. You are taking a loan from the insurance company, and they are charging you interest. You have to pay that interest. The proponents of this system claim that because your cash value continues to grow while you have a loan outstanding, you are engaging in arbitrage. If the policy pays you 4% and the loan costs you 5%, the net cost is small. But wait, why would you pay a net cost to access your own money? If you had that money in a high-yield savings account or a brokerage account, you could just withdraw it. Cost zero. With the insurance scheme, you are paying a spread to access against you. It can eat away at your death benefit and eventually cause the policy to lapse. If the policy lapses with a loan outstanding, they have spreadsheets that look like NASA flight plans, just to track their premium payments, loan repayments, and dividend reinvestments. Reinvestments. Life is messy. Can admit you forgot you get to check the mail and you divorce. If you mess up the fun of these policies, strategy, you have an automated transfer to an index fund. That's it. You don't need a consultant or a spreadsheet to manage it. In personal finance, simplicity is an asset. Complexity is a liability. Complexity hides his need. So who actually wins in the infinite banking scenario? The insurance agent. These policies require massive premiums, often tens of thousands of dollars a year, to work properly. Remember that commission structure we talked about earlier? A $20,000 annual premium generates a massive payday for the person selling it. This is why you see so many influences pushing it. It isn't because they discovered a secret of the Rothschilds. It's because the compensation structure for selling permanent life insurance is one of the most lucrative in the entire financial services industry. If you're ever curious about the strong promotion of a particular item or service, it's often insightful to get the underlying incentives. Now, before I get an angry email from every insurance agent in the country, I have to make a concession. Whole life insurance is not a scam in the legal sense. It is a contract.
And it does exactly what the contract says it will do. And there are people, a very small group of people, for whom this product actually makes sense.
We need to define who those people are, so you can see if you are one of them. The first group is the ultra-wealthy who are facing estate tax issues. If you are worth $20 or $30 million, the government is going to take a huge chunk of your estate when you die. Whole life insurance can provide immediate, tax-free, liquid cash to pay those taxes, so your heirs to sell the family business. They aren't buying it for the investment. They are buying it for the liquidity event. The second legitimate use case is for families with special needs dependents. If you have a child who will never be able, term insurance expires, whole life is permanent. Whole life is permanent. In this scenario, a guarantee is the most important feature. You cannot afford to outlive your coverage. It acts as a permanent safety net for a permanent. But notice the pattern here. These are specific permanent needs. Most of us do not have a permanent need for insurance. We have a temporary need to replace our income while we are working and raising a family. There is one final group, the high-income earner who has maxed out everything else. If you are putting the maximum into your 401k, your IRA, your HSA, or ground, and you still have cash piling up that you want to shelter from taxes in a conservative vehicle, whole life can act as a bond substitute. You only look at this after you have built a robust portfolio of stocks and real estate. The problem is that you sell this to. So take a look in the mirror. Are you worth $20 million? Do you have a special needs dependent requiring lifelong care? Have you complete? If the answer is no, then you almost certainly do not need whole life insurance. You are paying a premium for features you do not capital. For 95, maybe 99% of the population, the boring, simple path of term insurance plus investing is mathematically superior.
This brings us to the most important part of the video. If you agree with the logic, what do you actually do? How do you execute the buy term and invest the different strategy without messing it up?
Step 1 is to get the insurance in place before you cancel anything. Do not, I repeat, do not cancel an old policy until your new one is active. Active. Health changes. You might not be as insurable as you were 5 years ago. Go online, shop for a term policy. Aim for coverage that is 10 to 12 times your annual income. If you make $100,000, get $1 million policy. It is shockingly cheap. Lock that policy. Step 2 is the breakup. If you have a whole life policy you realize you don't want, you have options. You can surrender the policy and take the cash surrender premiums. That hurts. It feels like losing money. But you have to view those past premiums as a sunk cost. That money is gone. Strategy? Often the math says, take the hit, grab whatever cash value is left, and move on. Be prepared for your agent to fight you. Math. Step 3 is the most critical. You must actually invest the difference. If you save $400 a month on premiums and just on lifestyle account, you have to automate this. Set up a monthly transfer from your checking account to a brokerage account for that exact amount of money you saved.
Fun. If you do this religiously, you will see that account grow. In 10 years, you will likely have more in that account than you ever would have had in cash value.
Over it. When you unbundle your insurance from your investments, you gain flexibility. If you have a bad year and can't contribute to your investment, manageable. If you hit a home run with a business idea and want to invest more, you can dump extra caveats or fees. You are not relying on an insurance company's black box formula to determine your wealth. You are stripping away the fees, the commissions, and the complexity, and works. So, is whole life insurance a scam? Technically, no. But is it a bad deal for the vast majority of people? Absolutely. Absolutely. It is a product that solves a problem most people don't have, at a price most people shouldn't pay, with a commission structure that incentivizes works. It relies on you believing that you need an external entity to manage your resources. The moment you take responsibility for your own part, I want you to check your own policies. If you have a whole life policy, look at the cash value, look at the premiums paid, calculate the return back. If you found this breakdown helpful, or if you are an insurance agent who is currently typing a furious comment, let me know below. I read the comments, especially the angry one. Remember, nobody cares about your money more than you do. Not your agent, not your bank, and certainly not the insurance company. Take control, run the net. You just need to follow a few simple steps. First, secure your funds and make sure they're working for you, not the other way around.